Canada, as we mentioned, reporting a trade surplus for September, the first one since January and the start of the trade war with the U.S. Let's talk about this with Karl Berger. He's a senior wealth consultant and investment counselor, Cidel Asset Management. Thanks for joining us today.
Nice to be here.
So not a big surplus, 153 million, but it's a reversal from that big deficit we saw in August. Why do you think we saw a bounce back like that?
I mean, it'll be interesting to see as we go forward, Morella, whether this was just a bit of an anomaly. It's a volatile series of data. It was actually a good number right across the board, as your previous segment noted. As important, though, obviously, will be what happens over the course of the next number of months. So I don't think anybody should claim victory at this stage. There's still lots to happen as CUSMA gets renegotiated, or if CUSMA gets renegotiated, and what form that takes. So there's a lot to come still.
Okay. When you look at both the jobs data and the GDP data in Canada, both surprises to the upside, do you think tariff concerns are over?
No, absolutely not. What this says maybe is that people have been extremely negative on Canada to this point. And perhaps there's a glimmer of hope that things won't be quite as negative as we might have believed over the course of the last 6 or 12 months. And if you look at the performance of the TSX over the course of 2025, I don't know that many people would have expected what we've experienced or what we've seen out of the TSX, given how dire the tariff situation was likely to be for Canada and may still be. But we're at a far better place, I think, in the last couple of weeks, or the data from the last couple of weeks is showing that we might not be in as bad a place as many people would have expected at this stage. And that's showing up in the currency. It's showing up in interest rates. And it might mean that investors need to change the way they're thinking about the Canadian portion or the international portion of their portfolios. Again, it's a little bit early to draw any fast conclusions because they are very volatile data series, and it's a pretty tricky time still. But there's some interesting things going on.
Yeah, the Bank of Canada decided, as you know, to hold the lending rate, given, as you say, it's a tricky time, and the data is the data, which could change very quickly, as we see. Was it the right time to just hold the rate?
Oh, I think so. And remember, too, that the Bank of Canada is far, far ahead of the Federal Reserve in terms of that easing path. We've been on that path for the better part of 12 months now, and maybe even a little bit more. The U.S. is much more recent into that cycle. So Canadian interest rates are quite a bit lower than the U.S. and have been for some time. We've had the benefit of a very, very weak Canadian dollar relative to the U.S. dollar for some time. In my experience over the last 20 or 30 years, that always or usually creates the conditions that ultimately support a stronger Canadian dollar. So maybe we're starting to see a little bit of that. But at this point, it looks fairly clear that at the very least, the divergence where Canada is easing more quickly than the U.S. appears to be over. And now maybe we hold steady for a little bit while the U.S. eases in the short end of their curve.
We had earnings today from Dollarama, 22% spike in sales. Are consumers still being cautious? Are consumers still being careful? Do you think this is part of the story for Dollarama?
Yeah, I think it's a big part of the story. They're also doing a brilliant job in terms of execution of their domestic and their international strategies. But Dollarama is very, very well placed to take advantage of a stressed consumer, let's say. And so if there's all kinds of price pressures in different parts of a consumer's world, naturally, they're going to gravitate to a place where they can spend less money if they have less. And Dollarama has done very, very well at exploiting that. It's an expensive stock at this stage from a valuation standpoint, as you might expect when a stock is up to the extent that you'd see on that graph there over a fairly short period of time. But a very, very well-run company at this point, and we're quite comfortable holding it.
The strength in tech has helped investors in North America quite a bit this year, pushing them up. That being said, AI-related stocks have seen some pressure probably since November now. Is it time to rebalance ahead of 2026? How are you advising at this point?
I think every investor should take a look at how their overall portfolio sits, liquidity that they might need over the course of the next 6 or 12 or even longer months, just based on what their personal situations suggest. The AI and tech boom is so fascinating because there's been an awful lot of money spent in tech There's going to be an awful lot more money spent in the tech space. Our concern, I would say, not fear, but our concern is that at some point there'll need to be a pretty significant return on that investment in order to incent these companies to continue to spend more. And it very likely won't be linear, which will create some volatility. And so at this point, we're seeing a bit of a pause over the last 6 weeks or so of what has been a very, very strong trend, really since Liberation Day on April 2nd, when the tariff surprise first came down. Since then, we've had pretty smooth sailing in terms of the markets and the inflows, capital inflows into it. So not at all surprising that we'd see a little bit of a hesitation at this point and maybe a bit of a retracement. But again, there's an awful lot to happen in the early part of 2026.
All right, Karl, I'm going to leave it there with you. I'm out of time, but thank you for your time. I appreciate it.